Okay, during this review process, you'll notice some of the problems are exactly like they are in the book and some are not. So I'll bring you and I'll alert you to which ones are and which ones aren't. They're similar, but not exactly the same. So let's go to exercise 2.4, which is not exactly the same as in your book. We will actually be using the information presented here to complete the journal entries. So you may want to print off a copy of these. You know what? I will make them available in Blackboard so you can download them and have them in front of you. So we need to complete the journal entries for each of these transactions. Going back to debiting and crediting and making sure we remember all of those rules. So in the first transaction, they issued 1,000 shares of common stock in exchange for $5,500 cash. Well, we would, debit cash or increase it on the debit side and increase the common stock equity account for $5,500. Remember, common stock is a part of paid-in capital or contributed capital. Contributed capital, or some books call it paid-in capital. That's where we keep track of the amounts the owners give the corporation when the corporation still first sells stock. In our second transaction, the company purchased furniture and fixtures at a cost of $6,000. $4,000 was paid in cash, and a notes payable was signed for the balance owed. So they purchased the asset furniture, so we will increase furniture account with the debit, decrease cash of $4,000 with the credit, and then increase the liability notes payable on the credit side $2,000. Just going back through those rules of debiting and crediting. In number 3, they purchased inventory on account at a cost of $2,500. The company uses the Perpetual inventory system. So all this means is instead of using a purchase account, they use inventory, the asset inventory, whenever they purchase more inventory. So they'll debit the inventory account for $2,500, and since they purchased it on account, they'll increase accounts payable, the liability, on the credit side. In the next transaction, credit sales for the month totaled $3,000. The cost of goods sold, so they actually sold a product, they charged the customer $3,000 for the product. The cost of the goods that were sold, so the original cost they paid for the inventory, was $2,200. So it takes you back to Chapter 5 of Accounting 111 when you dealt with inventory. So we're going to increase accounts receivable because it was credit sales on the debit side and increase sales or sales revenue, $3,000. We'll then debit the expense cost of goods sold for the cost of the goods and credit inventory to decrease the inventory asset account $2,200, the original cost of those goods. In the fifth transaction, the company paid $1,000 in rent on the store building for the month of January. So this was the items that happened during January. So they will debit rent expense for $1,000 and credit cash. So we increase the expense account on the debit side, decrease the asset cash on the credit side. Okay, number 6, paid $370 for an insurance to an insurance company for fire and liability insurance for a 1-year period beginning January 1 of year 1. Well, we'll debit prepaid insurance for $370 the day we pay it. That's an asset. Because the insurance coverage will be used up over the year, as of the day we pay it, it is not an expense yet. And we will credit cash because we paid with cash. And number 7, they paid $2,500 on account for the merchandise purchased in 3. So number 3, they purchased the inventory on account. Now they're paying on the accounts payable. They'll debit accounts payable, decrease the liability for $2,500, and they're paying with cash. That's the assumption here. We decrease the cash account, $2,500. In number 8, the company collected $3,100 from customers on account. So now they sold to customers, the customers owed them. We're keeping track of that in accounts receivable. Now the customers are paying on their accounts receivable, so the company is receiving that cash. They'll debit the cash account, increase it $3,100, decrease the accounts receivable account for the $3,100. The customers no longer owe that. In number 9, company paid shareholders a cash dividend of $600. Remember, we keep track of dividends usually in its own dividends account, or sometimes we decrease retained earnings. In this case, we're going to decrease retained earnings directly, not use a dividends account. Remember, retained earnings is exactly that. It's the earnings that are still kept in the business. Who is entitled to the earnings? The shareholders. So whenever money is sent to the shareholders, they're really sending them the profits or the retained earnings. So we decrease retained earnings when a dividend is being paid out and decrease cash, because that's what their company is sending, cash. In number 10, the company recorded depreciation expense of $120 for the month on the furniture and fixtures. Remember what depreciation is. It's the expensing of the cost of a plant asset because of use. That's all we're doing. Instead of expensing the furniture and fixtures in the year we buy them, no, we expense them as they're used up. We expense what we paid for them. In this case, the company is expensing $120. So they debit depreciation expense and credit not the furniture and fixtures account, but the contra account, accumulated depreciation. Remember, contra accounts are where we keep detailed information about another account because we can't decrease that account directly. And that's what accumulated depreciation is doing, storing information about furniture and fixtures. How much of the cost of that asset did we actually expense? In number 11, recorded the amount of prepaid insurance that actually expired for the month. Now we're getting into adjusting journal entries. So now remember, they paid $370 for a 12-month insurance policy. Now it's January 31st. We need to expense 1 month of that because 1 month has expired. So debit insurance expense for that 1 month, or $31, and credit the asset prepaid insurance, $31, because we've used that much of that asset up. Okay, so great review on the journal entries, everyday transactions of a company. In exercise 2.5, this is from your book, and it's just a quick matching. And so there's the answer key. Really quick, I'm going to go through them. Source documents are K, used to identify and process external transactions. Transaction analysis is E, determine the dual effect on the accounting equation. A journal is A record of the dual effect of a transaction in debit-credit form. A posting is J, it's transferring your balances from the journal to the ledger. Remember, you have a book that's called the journal. That's where you put your journal entries, where you first record a transaction. The journal information is a transfer to the other book, the general ledger, and that's where all your T accounts are. So you can collect transactions that affect like cash on the cash T account. Unadjusted trial balance is the list of accounts and their balances before adjusting entries. What is an adjusting entry? It's an eternal event, so it's something we do in accounting at the end of a reporting period, and it's really done to make sure all the revenues and expenses are recorded. All the revenues and expenses are recorded. What is an adjusted trial balance? H, a list of their accounts and balances after adjusting entries. Then we have our financial statements, which are primary means of disseminating information to external decision makers, our formal reports, financial statements. Closing entries are entries that zero out the owner equity temporary accounts, revenues, and expenses. Now, if an account for dividends is being used, that is also zeroed out. And those balances are zeroed out and transferred to retained earnings. Post-closing trial balance is the trial balance, a list of accounts and their balances after closing entries. And I'm not making you responsible for a worksheet, but it is a means of organizing information, not part of the formal accounting system. And I don't make a big deal about worksheets. They talk about them in your book. They still teach them. I don't, though, because they were necessary when we did a lot of manual accounting or we didn't have access to PCs and software at our fingertips like we do now. But the worksheet has really become obsolete because accountants enter journal entries right into their software and their general ledger is immediately updated, and there's really no use for it. All right, moving on to exercise 2-8, which is not the one in your book. It's similar, but not exact. So you want to print off this information. We're going to prepare the necessary, this is the next step of our accounting cycle, adjusting entries at December 31st, year one for the Velto company for each of the following situations. Assume no financial statements were prepared at all during the year, and there have been no adjusting journal entries throughout the year. So here's what happened. Here's what sets us up. On 2-year fire insurance policy was purchased on July 1. Oops, I don't have that one in front of me. There it is. Okay, I got it. And of year one for $10,000. So remember, on that day, the company debited. Here's what they did. The company did. They debited insurance expense for the entire $10,000. So remember what that's saying. Basically, that $10,000 occurred, or all the expense happened in year one. Well, if this is a 2-year insurance policy, that's 24 months. How much is that per month? 10,000 divided by 24 months. Grab my calculator. I should know that off the top of my head, but I don't. Oops. Is about $416.67 per month. Well, how many months really is an expense in year one? Well, they started it in July. July, August, September, October, November, December. 6 months of it. So multiply that by 6. 416.67 times 6. You get about $2,500 of the $10,000 should only be an expense. So we have to make a journal entry to correct that. So watch what happens. July 1, the company debited insurance expense and credited cash. On December 31st, they've got to pull some of the money out of insurance expense and debit it to prepaid insurance. How much? 18 of the 24 months, or $7,500, because only 6 months have expired. So only 6 months should be an expense. How much is an expense right now? 10,000. How much should be? 2,500. So we debit prepaid insurance for 7,500 and credit insurance expense for the other 7,500. You just transferred it out of the expense account and into the asset account where it belongs. Now, if the company properly had recorded this, we would have debited insurance expense 2,500 and credited prepaid insurance. But because they recorded it incorrectly to begin with, now we've got to correct it. Depreciation on equipment totaled $12,000 for the year. It's pretty straightforward. We debit depreciation expense, $12,000, credit accumulated depreciation for $12,000. And we just reviewed that information about depreciation. Number 3, employee salaries of $20,000 for the month of December will be paid in early January of next year. They haven't been recorded at all, and they'll be paid. Well, they're an expense for December, so we have to debit salaries expense for the full $20,000, credit salaries payable. This is an accrued expense, an expense that's occurred but has not been recorded yet. Just because you didn't record it doesn't mean it isn't an expense. And number 4, on October 1, year 1, the company borrowed $220,000 from a bank. The note requires principal and interest at 12% to be paid on April 30th of year 2. So 6 months, right? Well, let's see. November, December, January, February, March, April. Yes. All of October, November, December, January, February, March, and April. So that's 7 months. Well, that doesn't matter. What matters is how much interest has occurred by the end of year 1. 220,000. So basically you're saying if we had to pay interest on December 31st, if we had to, how much would we owe? 220,000 times 12%. Remember, interest rates are always stated in terms of 12 months. It doesn't matter how long the note is for. They're always stated in annual terms. So that's 12% or 1% per month. Well, we need to know interest for October, November, and December, 3/12. So take 220,000 times 12% divided by 12 times 3, $6,600. So on December 31st, we debit interest expense because the interest occurred this year and credit interest payable. Do we have to pay it on December 31st? No. So if we don't have to pay it and we're recording an expense, then we owe it. Credit a liability. The 5th one, on December 1st, year 1, the company received $2,400 in cash from another company that is renting office space in Velto's building. The payment represents rent for December and January and was credited to deferred or unearned. Deferred is another word for unearned rent revenue. So December 1st, they debited cash and credited unearned or deferred rent revenue for $2,400. And that's for 2 months, so $1,200 a month. So at the end of December, we should debit deferred rent revenue for half of it, or $1,200, decrease that liability account, and now credit rent revenue for December's rent. As of December 31st, that is rent revenue. Okay, so there is a review of adjusting entries. We're going to have 1 or 2 more reviews of those. In 211, we have this is one that you should print out. It is not in your book, exactly as you see it here. The ASME Wholesale Food Company fiscal year end is June 30th. Excuse me. The company issues quarterly financial statements requiring the company to prepare adjusting entries at the end of each quarter. And that is when we typically do adjusting journal entries. If you're going to make a financial statement, you must make sure all the revenues and expenses through the end of that time period are recorded, and that's what adjusting entries do. They make sure we have all of revenues and expenses recorded so that our financial statements are correct. So we have to assume all quarterly adjusting entries were properly recorded till the present, prepare the necessary year-end adjusting entries at the end of June 30th, year 2 for the following. So on December 1st of year 1, the company paid its annual premium of $8,000 for the year beginning December 1st. So let's go over to that one. Well, that is a annual 8,000 divided by 12. $666.67. Okay. So they would have recorded a journal entry at the end of December and then January, February, March. 4 months of that as an expense already, because by the end of the first quarter, it would be their third quarter, March 31st. All journal entries have been made. So, okay. So we need to account for 3 more months, April, May, and June. So 8,000 divided by 12, 6667 times 3 more months, $2,000. So on June 30th, April, May, and June's insurance expense must be recorded. Debit insurance expense for $2,000, credit prepaid insurance. And since they didn't tell us they recorded the insurance payment originally any other way, we assume it was the correct way. The second one, on August 31st of year 1, the company borrowed $88,000 from a local bank. The note requires principal and interest at 9% to be paid August 31st of the following year. Well, so far, the company has been recording interest expense at the end of each quarter. So as of March 31st, all interest expense related to this loan should have been recorded. We need to record the interest expense related to April, May, and June. So we take $88,000 times the 9% times 3 months of the 12 months that the interest rate relates to. So $1,980. We will debit interest expense $1,980 and credit interest payable $1,980, just like we did in the prior journal entries. In 3, ASME owns a warehouse that it rents to another company. On January 1 of year 2, ASME collected $25,000 representing rent for 2-year calendar year. So it's all of it's January 1 through the end of that year, and then the next year. So that's 24 months of rent, or around $1,041.67 a month. Remember, any adjusting entry related to this has been recorded through March 31st. Well, originally when this was recorded, it was debited to cash and credited to deferred rent revenue, or that liability account, unearned rent revenue, same thing. We need now to show 3 months of that as rent revenue. So $6,250. Oh, hold on one second. Oh, I'm sorry, for the year 2 calendar year. I thought it was for a 2-year. Okay, I apologize for that. It's really a 12 month. So 25,000 divided by 12, and then multiply that by 3. So 6,250 would be debited to the liability account, unearned or deferred rent revenue, and then credit rent revenue 6,250, because that portion of it has now been earned by the company and can be recorded as revenue. In the next, depreciation on the office building is $16,000 for the fiscal year. So that's for the full 12 months. We only need 3. So 16,000 times 3/12, because the other months have already been recorded so far. Debit depreciation expense, credit accumulated depreciation building, 4,000. And finally, employee salaries and wages for the month of June, year 2, of 20,000 will be paid after the year end. It'll be paid July 20th. So we want to debit salary and wage expense for the full 20,000 and credit salaries and wages payable for 20,000 and accrued expense. The expense is incurred just like the interest. It isn't paid yet. We still got to record it as an expense and show it as a liability. Okay, moving on to exercise 212. Now 212 is going to wrap up the accounting cycle. So they present us with, so we've seen journal entries. The assumption is we posted those to the T accounts, created an unadjusted trial balance. We've seen adjusting journal entries where we update the unadjusted balances to make them correct with regards to revenues and expenses. If there were any missing, that's when adjusting journal entry kicks in and gets them recorded. We would post those to the T accounts and create an adjusted trial balance, which is what is in front of us. And it's actually this trial balance that it's used to create your financial statements. So we're going to create the income statement at December 31st of year one, a classified balance sheet, we'll review that at December 31st of year one, and then we'll be finished with the accounting cycle and we'll complete closing journal entries to prepare the general ledger T accounts to start collecting information in them for next year. So, as far as Blue Boy Cheese Corporation, the income statement would be the sales revenue of $850,000 minus the cost of goods sold would give us gross profit. Remember, cost of goods sold is an expense and it will decrease just like any other expense. Gross profit is a calculation on our income statement. We then subtract our operating expenses, starting with salaries, rent, depreciation, advertising. You don't see interest there, not yet, because it's not considered an operating expense. We total up the operating expenses that are presented, subtract them from gross profit to get operating income. Now, it doesn't mean interest is not an expense, it's just subtracted after determining operating income. It's considered an other expense. It's presented, the $7,000, and it's subtracted to ultimately get to net income. So a very primitive version of our multiple step income statement, but a great review at that. Remember, only revenues and expenses, gains and losses on the income statement. And this is called a multiple step because we present a few accounts, we do a calculation. Present some more accounts, do a calculation until we finally arrive at net income. Now, the classified balance sheet. Remember, a classified balance sheet means we now break down or categorize our assets and liabilities between current and long term. So we start with Blue Boy Cheese Corporation, the balance sheet, December 31st, year one. We'll first list the assets. Current assets are our first asset category. They include cash, accounts receivable, inventory, and prepaid rent. These are all assets that will be used up in the coming year. That's the definition of a current asset. Total them up. Then we start with our other categories. Now, the only other category of asset here is equipment or plant assets, office equipment. We present that dollar amount and we subtract from it the contra that we've been collecting information in about the office equipment. So this is saying we have office equipment that cost us $625,500. We've expensed $265,000 of it as depreciation. So our book value is $360,500, and that's what's reported on the balance sheet. Add the total current assets to the amount of equipment, and you get total assets of $745,000. Now our liabilities and shareholders' equity. Current liabilities, these are liabilities that will be paid in the coming year. Accounts payable, salaries payable, interest payable. And if we know notes payable will be paid off in the coming year, it is listed here as well. And I believe it does say it in our trial balance, it's due in 6 months. So if we're going to pay it off by the end of year 2, it is a current liability. With the dollar amounts, total them up, total current liabilities. Now, since there's no long-term liabilities, we could then go to shareholders' equity. Here we list common stock and the amount of retained earnings, which they've already determined for us. It's a little different than what's on your trial balance. Why? Because they added in the net income. Retained earnings has a credit balance in it of $125,000, but remember there were $42,000 in net income on our income statement, so that's added in to make $167,000. So total shareholders equity is $617,000. add the liabilities to the shareholders' equity, and you're done with your balance sheet. Assets equal liabilities and shareholders' equity. So that was a great review. Finally, we need to do our closing journal entries. Remember, the purpose of closing journal entries is to reset the temporary accounts, revenues, expenses to zero, because we're only allowed to collect information in them and accumulate it over our 1-year accounting year. When that accounting year's up and we've reported everything in our financial statements, we remove their balances out of their current accounts and send them back to retained earnings. So let's see how that's accomplished. Sales revenue is debited. Right now it has a credit balance of $850. We need to debit it. And we credit our special income summary account. That's this account we only use during closing journal entries. Then we credit each of our expense accounts individually. That will reset them to zero once we post them. Debit the income summary account for their total. So you should post these as you go, and you'll see sales revenue will be zero, the T account. The income summary will now have a balance in it of $850,000 on the credit side. Then you credit each expense. Its balance will be zero. And the income summary, you'll post a debit of $808,000. Well, the next thing you have to do is reset the income summary to zero. Zero it out. It currently has more credits than debits. So you want to debit the income summary for $42,000, which is the net income, right? And transfer that into retained earnings, $42,000. So the income summary T account is just that. It's a place we summarize income to take it out of its first place, its first holding area, whether it be a revenue or expense, put it into this common holding area before it goes off to retained earnings. Okay, so let's look at a comprehensive problem. So now this is problem 2-2. It is in your book, the information, and these are all the journal entries related to 2-2. So we've seen some of these. I'm just going to go through them quickly, and like I said, if you have questions, you could post them out on the discussion board. So they give us a following post-closing trial balance information about this company. So we have a chart of accounts to work from. Remember, a chart of accounts is just a list of all the accounts. Trial balance is a list of the accounts with their balances. So in January, the company sold for cash $3,500. They sold merchandise. The cost of the merchandise was $2. Debit cash, credit sales revenue. Increase the cash, increase the sales revenue. So we always want to increase sales revenue whenever we're selling to a customer. Then we debit the expense account, cost of goods sold for the cost of the items, credit inventory. On January 2nd, purchased equipment on account for $5,500. Want to increase the asset equipment on the debit side, increase the liability accounts payable on the credit side. And we do that because that's just the rules of debiting and crediting. So if you're like, I don't remember that, get back there and review it. Received a $150 bill from the local newspaper for an advertisement that appeared in the paper on January 2nd. Okay, it doesn't say anything about paying it. Doesn't mean you didn't have advertising expense. You had the advertisement. So you debit advertising expense and credit accounts payable to show that you owe it. Increase the liability. January 8th, they sold merchandise on account for $5,000. The cost of the merchandise was $2,800. Again, now they have a sale. We credit sales revenue. Increase that account. They didn't receive any cash yet, so increase the asset accounts receivable. Increase the expense cost of goods sold for the cost of the goods that they sold, and decrease the asset inventory. They sold it. It's gone. It should be decreased. January 10th, they purchased more merchandise on account. We'll increase the inventory account on the debit side. It's on account, so we have to increase the liability accounts payable. The 13th, purchased equipment for cash, $800. Increase the equipment account on the debit side, decrease the cash account on the credit side, $800. On the 16th, they paid the entire amount due to Strong Company. Well, that's from the January 2nd purchase. So they're going to debit accounts payable, decrease the liability. They're paying on it now. and then decrease cash for $5,500 on the credit side. The 18th, they received $4,000 from customers on account. So now they're receiving cash. They increase the cash on the debit side. They're receiving it from customers on account. So these are customers whose revenue has already been recorded. It's just that we're keeping track of what they owe us in accounts receivable. They don't owe it to us anymore. We credit their account. Credit accounts receivable. On the 20th, they paid $800 to the owner for the building for January's rent. Increase rent expense on the debit side. Decrease the asset cash on the credit side. January 30th, they're paying more expenses, $3,000 for salaries and wages. Debit salaries and wage expense, $3,000, because that's what we do. We increase expenses on the debit side because we're trying to collect all the expenses for a period of time. And then we decrease cash on the credit. And finally, they paid a cash dividend of $1,000 to shareholders. We're going to decrease retained earnings directly for the dividend, debit it for $1,000, and then decrease the cash account, credit it for $1,000. Okay, so those are the journal entries. I went through them kind of quickly. You need to become familiar with all of those rules of debiting and crediting and knowing how to do journal entries. Now, I don't have the answer key for the T accounts, but at this point, you should know how to do a T account and review it in your book. You should have T's for all the assets, each liability, in each part of equity. And you will transfer or post each of these items to the respective T account on the correct side. And then you will find a balance in each T account. Then you'll create your first trial balance, which is an unadjusted trial balance. And that's what it will look. Remember, an unadjusted or any type of trial balance is a list of each account in your general ledger T accounts with their current balance. So cash should have a debit balance of $1,400 after going through the process I just talked about. Accounts receivable, a debit of $3,000. Inventory, a debit of $9,700. Equipment, a debit of $17,300. Accumulated depreciation will have a credit of $3,500. Then the liability accounts payable will have a credit of $12,650. Then we have the equity accounts. Common stock will have a credit balance in it of $10,000. Retained earnings, a credit of $5,500. Sales revenue, a credit of $8,500. And then each of our expense. Now, if you're looking at this going, wait a second, don't forget, you needed to start each account with its beginning balance. So if you did not do that, go back and do it now, and then your balances should agree here. Remember, every chance we get to prove debits equal credits, we take it. And this is one opportunity for us to do that. So we total our debit column, total our credit column, and make sure they equal. If they don't, you've got to find out why. Okay, so that's problem 2-2. In problem 2-3, it's a very comprehensive problem about adjusting journal entries. So that's all we're focused on here. So we kind of pick up at the end of problem 2-2, but with a different company. So they give us their unadjusted trial balance and ask us to do the adjusting journal entries. And we need more information in order to do these. So this is a hard part of being the accountant. You have to analyze this information. It's just not like a regular transaction. We got to read it and figure out what the heck happened and how do we make a journal entry to reflect that. Remember, the key reason for adjusting journal entries is we're just finding missing revenues and expenses and getting them recorded so that when our financial statement is done, it reflects the true amount of revenue and the true amount of expenses. So in number 1, depreciation on the office equipment for the year is $10,000. Debit depreciation expense and credit accumulated depreciation. Employee salaries and wages are paid twice a month, on the 22nd for salaries and wages earned from the 1st through the 15th, and then the 7th of the following month for wages from 16th through the end of the month. Salaries and wages for that December 16th through December 31st time period were $1,500. Well, as of December 31st, this was an expense to the company. So they have to record it. They're not going to pay it till next month. So as of December 31st, it's a liability. debit salary and wage expense, credit salary and wages payable. In number 3, October 18th, Pastina borrowed $50,000 from a local bank and signed a loan. The loan requires interest to be paid annually on September 30th. Well, just because you don't have to pay it till September 30th of next year doesn't mean it's not occurring. Interest occurs every second of every day. It's accumulating or accruing. So as of December 31st, if they had to pay any interest, or the question is, would they have any interest due if they were required to pay it? Absolutely. They would owe 3 months worth of interest. So take the principal of $50,000 times 15% times 12% interest rate times 3 of 12 months. So we debit interest expense, and that should be credit to interest payable, $1,500. In number 4, March 1st of the current year, the company lent a supplier $20,000 and a note was signed requiring principal and interest at 8% to be paid on February 28th. So now it's a different scenario. Now it's the company loaned money to a supplier on a loan. Well, now they're receiving the interest. The question here is, did they have any interest earned by the end of the year? Absolutely. Interest occurs constantly. How much? 10 of the 12 months. Be careful here, all of March, because it starts March 1st. So all of March, April, May, June, July, August, September, October, November, and December. So 10/12 of that 8% is interest revenue by the end of this year. So we debit interest receivable and credit interest revenue for the interest that's been earned. And I apologize that they're not lined up properly. In number 5, on April 1st, the company paid an insurance company $6,000 for a 2-year insurance policy. They debited insurance expense incorrectly, but they debited it for the $6,000 in total. Now, if they leave all $6,000 in insurance expense, it would look like all $6,000 of insurance expired or occurred during this year. It didn't, only a part of it. So, as of April 1st, they paid the $6,000. So how much does not expire by the end of the year? Well, 9 of the 24 months has expired. So 15 months of the insurance policy must be reclassified to prepaid insurance. So we debit prepaid insurance $37.50 and credit insurance expense to correct that journal entry. In number 6, an $800 of supplies remained on hand at December 31st, 2018. So we go up to our adjusted trial or our unadjusted trial balance and we say, the current balance in our supplies T account is a $1,500 debit. When we counted the supply closet, only 800 of the supplies were on hand. So that means supplies decreased 700, credit supplies. We've used them up. They are now considered supplies expense. In number 7, customer paid Pastina $2,000 in December for, sorry about that. Try it again. A customer paid Pastina $2,000 in December for 1,500 pounds of spaghetti. It's going to be delivered next year. Pastina credited sales revenue. Well, that's incorrect. That's not revenue yet. So she has to debit sales revenue, so it nullifies that effect. There will be no revenue recorded then, and credit unearned or deferred revenue, because that's a liability. They owe that spaghetti as of December 31st. And then finally, on December 1st, $2,000 rent was paid to the owner of the building. The payment represented rent for December 2018 and January 2019 at $1,000 a month. So the assumption here is if we look up, we can see prepaid rent has a $2,000 debit balance. So they recorded it correctly. So we're going to debit rent expense for the 1 month or December's rent and credit prepaid rent. Okay, so those are some great review questions and problems for adjusting journal entries and for regular journal entries and those closing journal entries. So coming out of chapter 2, you really want to have a good understanding of that entire accounting cycle. And if you have your principles book, go on back to chapters 1 through 4, and that's what you learned. We put it into one chapter, but in your Accounting 111, you learned it over 4 chapters. Any questions at all, please post to the discussion board.